Project name: 419 Mindsets of a Scammer. This is an educational project that teaches about numerous methods scammers, fraudsters uses upon their victims, and also it helps to create public awareness of preventive measures that can be used to protect themselves from being a victim of scammers. AwarenessX is your first line of defense against scams. Number 1. What is investment scam? An investment scam refers to any fraudulent scheme designed to deceive individuals or organizations into making investments with the promise of high returns or minimal risk. These scams often prey on people's desire to earn substantial profits from their investments without fully understanding the risks involved. The scammers use various tactics to create the illusion of a legitimate investment opportunity, but in reality, the funds invested are either misappropriated or used to pay returns to earlier investors, creating a Ponzi scheme-like structure. Types of investment scam: investment scams come in various forms, and scammers continually adapt their tactics to deceive unsuspecting individuals. Here are some common types of investment scams. Ponzi schemes. In Ponzi schemes, fraudsters promise high returns to investors and use funds from new investors to pay returns to earlier investors. The scheme relies on a continuous influx of new investors to sustain the illusion of profitability. Eventually, when new investments dry up, the scheme collapses, causing significant losses. Pyramid schemes. Pyramid schemes involve recruiting new participants who are required to invest money and then recruit others. Participants at higher levels receive a portion of the investments from those they recruit. Like Ponzi schemes, pyramid schemes are unsustainable and result in financial losses for the majority of participants. Advance fee frauds. In these scams, fraudsters promise access to lucrative investment opportunities but require victims to pay upfront fees for various reasons, such as taxes, processing, or legal fees. Once the fee is paid, the promised investment never materializes, and the scammers disappear. Pump and dump schemes. Scammers artificially inflate the price of a stock or other investment through false or misleading information, often spread through newsletters, social media, or email. Once the price is artificially inflated, the scammers sell their holdings, causing the value to plummet and leading to losses for investors who bought in at the higher price. Offshore investment scams. Fraudsters may promote investments in foreign ventures or offshore accounts, often claiming tax benefits or high returns. These investments may not exist or may involve illegal activities. Internet and social media scams. Scammers use online platforms to promote fraudulent investment opportunities. They create fake websites, social media profiles, or emails to lure victims into investing. Binary option scams. Binary options are financial contracts with a fixed payout based on the outcome of a yes/no proposition. Some binary options brokers engage in fraudulent practices, including not paying out earnings, manipulating prices, and misleading investors about potential returns. Cryptocurrency scams. Cryptocurrency-related scams have become increasingly common. These scams can include fake initial coin offerings, ICOs, Ponzi schemes involving cryptocurrencies, and phishing attacks where scammers impersonate legitimate cryptocurrency platforms. Precious metals and commodities scams. Fraudsters may promote investments in precious metals like gold or commodities like oil and promise significant profits. However, they often overcharge for the products or misrepresent the investment's potential. Real estate scams. Real estate investment scams can involve fraudulent offers to purchase property or invest in real estate projects with the promise of high returns. Scammers may fabricate ownership or inflate property values. Energy investment scams. Scammers may offer investments in energy-related ventures, such as renewable energy projects or oil and gas drilling, with the aim of misappropriating investor funds. Foreign exchange, forex, trading scams. Some fraudulent forex trading platforms promise guaranteed profits with minimal risk. Traders may find it difficult to withdraw their funds or discover that the trading platform is rigged against them. How to avoid being a victim of investment scam. Avoiding investment scams requires a combination of skepticism, research, and caution. Here are some steps you can take to protect yourself from becoming a victim of an investment scam. Do your research. Thoroughly research the investment opportunity and the individuals or companies involved. Look for legitimate sources of information, such as official websites, regulatory agencies, and reputable financial news sources. Verify the credentials and background of the people promoting the investment. Be cautious if they have a history of legal troubles or are not easily traceable. Understand the investment. Make sure you understand the investment thoroughly, including how it works, the potential risks involved, and the expected returns. If the investment is overly complex or the promoters can't explain it clearly, it might be a scam. Check regulatory agencies. Verify if the investment or the company promoting it is registered with relevant regulatory agencies, such as the Securities and Exchange Commission, SEC, in the United States or similar authorities in your country. Legitimate investments and companies are usually regulated. Be cautious of high returns. Be skeptical of investment opportunities that promise extremely high returns with little or no risk. Legitimate investments always carry some level of risk, and high returns usually come with higher risk. Avoid pressure tactics. Scammers often use pressure tactics to rush you into making a decision. They might claim that the opportunity is available only for a limited time. Take your time to thoroughly research and evaluate the investment before committing. Beware of unsolicited offers. Be wary of unsolicited offers, especially if they come via phone calls, emails, or social media messages. Legitimate investment opportunities are rarely offered through cold calls or random emails. Seek professional advice. Consult with a qualified financial advisor or professional before making any investment decisions. A trustworthy advisor can help you assess the legitimacy of an investment and provide valuable insights. Avoid offshore or secretive investments. Be cautious of investments that promise secrecy, tax evasion, or special offshore benefits. Legitimate investments are typically transparent and adhere to legal and regulatory standards. Check for red flags. Look out for common red flags, such as guaranteed returns, complex structures that are difficult to understand, insistence on recruiting others, and requests for large upfront fees. Trust your instincts. If something doesn't feel right or seems too good to be true, it probably is. Trust your gut feeling and err on the side of caution. Report suspicious activity. If you come across an investment opportunity that seems suspicious or if you believe you have encountered a scam, report it to the relevant regulatory authorities or law enforcement agencies. This helps protect others from falling victim as well. Conclusion. To protect yourself from investment scams, it's essential to be vigilant, conduct thorough due diligence, seek advice from trusted financial professionals, and avoid investments that promise unrealistically high returns with little or no risk. Always remember that if an investment opportunity sounds too good to be true, it likely is.